So hey guys, this is Gorang and today we are going to continue learning about the income statement. In the previous video, I've already talked about the terminologies used in the income statement, and in this video, by taking an example of Nestle India, we're going to learn how to read an income statement. Along with that, I'm going to teach you about how to analyze this statement report, right? So let's get into it. Now I've opened the annual report of Nestle India, and I'm already on the financial statements area, which would be towards the end of the annual report. And this is the profit and loss statement of financial year 2019. So as you can see here, first of all, you notice that the year ended is 31st December 2019 in this case, whereas in the previous video, I told that the financial year in India ends on 31st March. So why is it 31st December in this case? Actually, Nestle is a foreign company. It's a Switzerland company. And over there, the financial year ranges from 1st January to 31st December. So whenever a company from foreign or from outside is established in India, they have a choice. They can follow any financial year according to their will. It's just that the taxes that they have to pay is according to our financial year. So that's it. Now you can see that this is for financial year 2019 and this side represents financial year 2018, and there's a comparison between the both. Now, and one more thing, that the rupees that this is represented are all in million. Okay. So coming to the first part, that is income, and under income is domestic sales, which basically is the revenue generated by the company by selling their products within India itself. And you can see over here that they have produced 116,000 million rupees, which is a decent increase from the previous year. Then we go next to the next point, which is export sales, which again has a decent amount. Then over here, you can see sale of products, which is just the sum of these two. But if you want to see which products the company produces and how much it generates from those products, you can go to this note number 32, which these notes are present after these financial statements. So I've opened it in another tab. So it was note number 32 here. Okay, now over here you can see the classification of the products. Now first of all, the highest is occupied by milk products and nutrition products, which amounts to 56,000 million rupees for the company, even though the quantity is lesser than the prepared dishes and cooking aids products. The prepared dishes and cooking aid products just includes the Maggi and all those products. And you can make one observation over here that 50% of the total revenue that this company generates is amounted to milk products and nutrition products. From here you can see that if there is some significant change in milk products, or in India itself there's some regulation imposed on milk products, it can have a significant impact on the company compared to the other products. Even if there's some impact on the other products, still that would be lesser compared to the impact which would be on the milk products. So that's one observation you can make over here. Now coming back to the statement, the other operating revenues amounts to 736 million rupees. For this you can again go to note number 25. Let's go over there and see what is there. So first of all, there are export incentives in this, which is actually that whenever a company exports its products, it might get some incentives. So it's just that. And there's another operating income which they have produced, that is from scrap sales. Now what is scrap sales? So whenever company manufacture its products, it's manufacturing the products, along with those products some scrap material is also produced. which is of no use for the company. So it sells these off to some scrap dealers or other companies which might use these, and it generated a revenue from the same. So that's it. Then coming to the next point, which is other income, right? Now, what is this other income? You can go to note number 26 again and see what this other income really is. Now, this other income constitutes of the interest which is generated from the investments and bank deposits, along with the interest which they got from tax-free bonds. Now, what is this bonds? Just like you invest in stock market, there's another financial security which is bonds, and they're said to be more safer compared to stock market. Along with this, they have also provided dividend on mutual funds. Along with this, they have gained from another financial assets, and that's it in the other income part. So this total income comes out to be 126,000 million rupees, which again is a significant increase from previous year, which is around 10% increase. Not exactly 10%, but yeah, around. Then coming to the expenses portion, the cost of raw materials, the cost of materials consumed by the company is 51,000 million rupees, which again you can go to note number 27 and find that it's just raw materials and packaging materials. So I won't bother going into this note. Then the next expense which they have shown is from purchases of stock in trade. So this is a new term which I didn't cover up in the previous video. And this means that whenever a company produces or manufactures its products, actually it doesn't manufactures all of the products by itself. What happens is that the company makes a deal with another manufacturer or another industry which might produce the same product, and after they produce that they manufacture that product, the company, that is Nestle India, buys that product from the manufacturer and puts their brand logo or whatever, and then sells it off. So they might be getting some incentives from this, or it might be beneficial for their costs or something like that. Because of that, they buy this from directly from the manufacturer, and the expense for this is shown over here. Now coming to the next point, which is changes in inventories of finished goods, work in progress, and stock in trade. Inventories is just the material or product which the company has produced and it hasn't sold off yet. So what is this? Let's understand this term by going to note number 28. Now look, as soon as you come to note number 28, you find these two things: opening stock and closing stock. Now what is this opening stock? So opening stock is the amount of material or product that the company has on the first day of the financial year, that is 1st April, or in this case 1st January, and this is represented over here. So the opening stock, they represent three types: finished goods, that means the products which have already been produced; work in progress, the products which are being processed right now; and stock in trade. Stock in trade, again, which they're buying from another seller. Then this sums up to 5,310 million rupees for the company in financial year 2018. Then closing stock comes out to be 5,370.4 rupees in financial year 2018. Over here, there's a bracket and 60.1 written in it. Bracket in financial terms indicates negative sign. So over here you can see that the closing stock is more than the opening stock, which says that the company sold less products and produced more products in this year. So that's why there's a negative sign over here. It it sold off less products and it bought more products, or it manufactured more products. Now there's one more thing to notice over here. So 5,370.4 million rupees, This is the stock that the company has at the end of the financial year of 2018. And this term is same as the opening stock of financial year 2019. So isn't this pretty obvious that whatever the inventories that the company would be having at the end of a financial year would be equal to the inventories that will be having on the beginning, because suppose this has this much inventory on 31st March, so it will be having at the end of 31st March, so it will be having this much inventory on the beginning of 1st April, that means in the morning. All right, and similarly over here the closing stock is this much. Again, they have produced more products and sold off less comparatively. Now, coming to the next point from here, over here in the previous point, if there's some significant change, then only pay some attention. Otherwise, it's not much of a concern. Then coming to the next point, which is employee benefits expense. Now, these are just the wages that are paid to the employees, and this amounts to this much. Then there are finance costs, which includes interest costs on employee benefits. Let's go to financial note number 30 to see what these finance costs are. So as you can see, these finance costs are just the interest costs on employee benefits and plans. So the company may be paying some employee benefit plans to their employees, and these are just the finance costs from them. And again, an interest on bank overdraft and others. So these are just the basic finance costs, which doesn't even account to much of their total profit or loss. And next is the depreciation and amortization, which I already covered in the previous video. Again, this point is not that much of a concern if there is no significant change, and you can leave it as it is. Then other expenses. Now this occupies a huge amount in the expenses. So let's go to note number 31 and see what these expenses actually are. So you can see over here that the other expenses actually includes most of the main expenses of the company, whether it's advertising, whether it's insurance, whether it's supply and chain of the products that they are selling, along with the security charges, so many things, rates, rent, traveling, everything is there in other expenses other than the things, other than whatever it's required for as the raw material. Now going to the next part, which is impairment loss on property, plant and equipment. So if there's any loss of property, whether the storage have been burned out or any other defect in some of their property or plants, and if they have impaired some loss due to that, they'll add it over here. So fortunately the company didn't make any loss from this in the previous financial year. Then comes net provision for contingencies. So what does this mean? So actually the company saves some amount of cash if something happens in the future, which is totally unexpected for the company. It saves some cash for it. So it's divided into two parts, basically operations and others. So that's how they divide it, and that's pretty much it. Next comes the corporate social responsibility expense, which is also called the CSR expense. And this is actually forced on them by the government, as they have to spend some amount of their money for social services. And this is the amount. You can just leave this portion. Don't pay much attention to it. So the total expenses comes out to be this. Then you find the profit before tax, which would be the total income minus total expenses, which comes out to be 26,000 million rupees. And from those, you subtract the current tax and the deferred tax. Deferred tax I've covered already. And you get the profit after tax. Then coming to the next part, which is other comprehensive income. And pay attention to this. It says that items that will not be reclassified to profit or loss. So what this means is that the company might have invested some amount of their revenue or profit into other financial securities like stocks or bonds and all these things, and they so assume that they invested in these stocks the previous year, suppose in 2018, and they haven't sold off their stocks till now. So we can't say that they have generated a profit because they haven't sold their stocks, and we can't even say that they have generated a loss because they have invested somewhere else. It's actually something that can be converted into a profit in future. So that's why they say that it will not be reclassified to profit or loss. And they mention all these amounts over here, and these other terms you don't have to pay much attention to them, because again, these are very small terms, very insignificant for the company. This is basically just fair value of cash flow hedges. You don't have to pay attention to them basically, other than if there's some significant change, then the company itself would mention about it. Then in the end, you'll get the profit from operations, which will come out to be 25,000 million rupees. Now from this, I want you to pay attention on some points and analyze from them. So I'll ask you a question before. You have two companies. One has a fluctuating revenue. That means one year the revenue is increasing, then another year it's decreasing, then increasing, then decreasing, and this has no pattern to it. Whereas on the other hand, you have a company whose revenue is increasing for the past 5 to 10 years continuously at a good pace. So which company would you trust more in? First or second? Of course the second, right? Because they have been they have gone through the ups and downs of the market. When the market was low, when the market was high, when the demand was low, when the demand was high, they have been through that situation and they have come out positively from that situation, right? So you'll trust that company which has been generating revenue for the past so many years. Now there might be some question that if a company generated a good amount of profit or they generated loss in the last year, then can you make your final decision from that? I would say probably not, because from the example of Nestle only, you can see that in 2015 there was a ban on Maggie, and because of that their sales were disrupted miserably. But they came out of it in the next year itself, and from then they have been growing their profits continuously at a good pace. So one of the metrics which I use while seeing revenue and profits is that there should be a 10% increase of both revenue and profits for the last 5 to 10 years. There may be 1 or 2 years which went on a downfall because of some external conditions. So that's very much possible. Like you can take the example of right now pandemic, all the businesses have been disrupted in some or the other way. So yeah, so you have to look at these small points. Now another thing is that, can you just believe that if the company's revenue is increasing, it's a good company? I would say no to this answer, because what if I tell you that most of the revenue that the company is generating is from other income and not from their revenue from the products? And other income, if you remember, includes the bank deposits income and mutual funds income and the cash that they generated from bonds. So all these are generated from other income, and this occupies a majority of their income, right? So that would be a bad point, because that means their business is not flourishing and they're dependent on some random source of income, which is actually common to most of the businesses. So there's nothing special about the business, and maybe the business might even fall in the coming years. So just pay attention to it, that where the company is actually. Now, one another point I want you to remember is that the percentage of the profit generated by the company should be good. Like, there might be a company which generates a lot of revenue but also has a lot of expense, so the profit it generates is very less, and over the years, because the revenue is increasing, it may be increasing by the same, around the same rate of the revenue, right? But that's not actually good, because it generates actually very less profit from the potential it has. And a great example of is this is the aviation sector, in which you might be seeing so many flights uh, traveling all around the world, but and they have a good amount of revenue, but their expenses are so high that the profit is left to a bare minimum. And during crises like this pandemic, they're not able to sustain, and many of these lead to bankruptcy. So this is one major concern and major point which I want you to remember. So by how you can calculate this, it's a simple formula. Just take upon profit upon the revenue, and from this you can find the, it's called actually the profit margin. So you can find the profit margin from here, and it should have a good ratio. Along with this, should you ignore all the remaining points: purchase of stock in trade, changes in inventory, depreciation, and all these? No. Have a look over them, but don't take them as something very important. If there is some abrupt change in them, then go to the annual report, or go to their notes and see what has happened, and maybe if that thing is not repeating over the years, then it's fine. So these are basically all the points that I want you to focus on. And the income statement is not fully complete, because there are some ratio analysis which you can get from the income statement. The profit margin was one of them, and this ratio analysis I'll be covering after completing all the financial statements. So that's it for today. So till then, keep learning, be safe, and thank you.